Happy Friday, Eric Bible with the Bible team at Neil Home Loans. And unfortunately, as the title reads, it's not the news I want to deliver on this Friday. Inflation moving in the wrong direction, which in turn is hurting mortgage interest rates. And I feel almost like I've got egg on my face, as last week it was turning point, things are good, rates are coming down, and like we've unfortunately seen for the last 2 years, that volatility is back in a big way. As we kick off the day, 30-year fix is currently sitting at 7.02, which is up from last week's 6.92. And again, I truly believed, as did the market, that we were entering a turning point, but wholesale inflation came in and painted a different picture. But there is silver lining. And really what I want to touch on today is what we can expect in the weeks to follow, especially with Fed Week next week. But most importantly, what advantage this can give buyers that were feeling pressure with the copious amount of demand in market, and ultimately how you can win. So let's dive into this week events, what this means for the Fed next week, what this means for rates, both short and long term, from a prediction and analytics standpoint, but more importantly, how this can be used to your buyer's advantage and most importantly, your advantage. So understanding this week in events, we got wholesale inflation, producer price index, which tells the market what wholesalers are paying for cost of goods in real time at the wholesale level. Mark was anticipating a pullback in that number, yet we saw an increase on not only the month over month for core, but also the headline and also the year over year. And it was not well received by market. Mortgage interest rates really spiked, pushing us back over that 7% threshold. And it's unfortunately been ugly since then. This really is kind of alarming Wall Street leading into the Fed's decision next week, and where again, it's very likely rates will be left unchanged. I don't believe they will raise rates, and I'll get to that here in a second, but it potentially just prolongs when we can finally start to see rate cuts, as they've been very vocal, they being the Fed, their mandate: employment, maximum employment, and price stability, inflation in control. Employment is starting to get a little weaker, as we saw earlier this month. Unemployment rise from 3.7 to 3.9. But inflation is being more stubborn than it had previously believed. So definitely something we'll be watching. I know the Fed is going to absolutely speak to this next week. That is what the market will be queuing into on Wednesday, the 20th. Jerome Powell's specific comments on the most recent 2 rounds of inflation data, CPI, both coming in hotter than expected, and more importantly, the wholesale side as well. So that cues up, though, there are some interesting components within retail sales, which shows us what the consumer is spending. Market was anticipating a gain on a year over year of 0.8%, yet it came in at 0.6. So where, yes, inflation is creeping back into the equation on both the consumer and the wholesale side, the consumer is slowing their spending. We saw spikes through the holidays, which was very common. Individuals will spend more during the holiday season, but in the month of February, we saw that pull back sharply, and it's really coming on the back of this immense debt load consumers are facing on their credit cards, and rates being where they're at. It's as if they're struggling to maintain. So at some point, we see that this will fold into the bigger picture, and it will force the Fed's hand. Until then, we have to face the facts. Rates are not ideal. And with that, as we've seen over the last 24 months, those rates have not stalled the market. But this absolutely can be an advantage to our buyers. As we know, the market has been insatiable throughout the United States, from Maine all the way back here to California. We've seen every single client that has submitted an offer has been met with multiple offers on every single listing in every single market for the better part of this year. Rates influence decisions. With rates now back above 7%, the expectation is that some buyer demand may cool, which will give buyers a competitive advantage entering into the spring market where demand was heating up. So again, another wonderful opportunity to engage with our database, advocate the message that yes, rates are high or higher than they have been in the last few weeks, but this could present a unique opportunity leading into the weekend with open houses. We're seeing more homes come on market throughout multiple municipalities. Let's take this advantage and win. Another thing that I want to continue to drive home here, the integrity of the upfront approval. This week, yet again, we had to unfortunately step in and keep more transactions going as the original lender blew the approval in escrow, telling the client, no, sorry, we don't have a loan. We are successfully transitioning those clients over to our database based on our process. If you are struggling with approvals, with communication from your lender, we want to speak with you. We have phenomenal programs. We have tremendous capacity to help get the deal done. As always, make it a wonderful Friday and an even greater weekend. We're here and happy to support you. Thank you.